You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, and welcome to The Investor Way with myself, John McEwen, and my co-host, Sam Ball. This week on The Investor Way, we have Airtel Africa, Novo-Nordisk, Rightmove, JD Sports, Trainline, and our US company of the week is Disney. Sam, do you want to kick us off with Airtel Africa?
Absolutely. A favourite of the show. So, Airtel Africa have come out with their full year results, and for anyone who's not heard of them before, they are a telecoms company that provides telecoms and internet services in 14 African countries. And they also have a segment of the business called Airtel Money, which we will talk about in a bit more detail. But it's almost like a traditional bank combined with a PayPal for Africa. So it's helping bank a lot of unbanked people where they maybe don't have a traditional bank account, but they have a smartphone, so they can use Airtel Money to get connected to banking services for the first time. So Airtel Africa come out with full year results. And if we go off the GAAP results, revenue was up 29.5%. Operating profit was up 45.1%. Profit after tax was up 147%. Earnings per share was up 212%. And the net cash generated from operating activities was up 41%. And if we use their adjusted measures, revenue was up 24% instead. Underlying EBITDA was up 30%. Underlying EBITDA margin improved by 240 basis points from 46.5% to 49.3%. Earnings per share was up 127% before exceptional items. Operating free cash flow was up 39%. So I think whichever set of results you take, they're both pretty good. And in terms of the highlights, they've said our customer base increased by 10.5% to 183.5 million, marking the highest net additions to date. Data customers grew by 14.8% to 84.2 million. As smartphone penetration rose another 4.7% to 49.5%. Data demand remains robust, with data usage per customer increasing to 8.9 gig per month from 7 gig, underpinning constant currency growth of 16.2% in data average revenue per user. Airtel Money continued to scale and deepen engagement with an expanded customer base of 54.1 million, which was up 21.3% year over year. Broader use cases and higher adoption across the digital platform drove 49% growth in annualized total processed value to over 215 billion in reported currency in the fourth quarter. This ongoing ecosystem expansion and increased customer activity supported an 8.6% uplift in constant currency average revenue per user. It said Francophone Africa and Nigeria constant currency growth was particularly encouraging, increasing by 17.1% and 47.5% respectively. Mobile services segment grew 22.6%, with data revenues now the largest component of group revenues, increasing by 35.2%. While mobile money continues to see strong operating momentum, up by 28.4%. And in Q4, constant currency revenues grew by 22.3% as Nigerian tariff benefits partially lapsed during the quarter. Strong revenue performance and continued benefits from our cost efficiency program resulted in underlying EBITDA margins of 49.3%, with all-time high margins of 50.3% in Q4. CapEx for the year increased 31.9% in line with revised guidance, and CapEx guidance for the 2027 year is approximately $1.1 billion. Leverage has improved from 2.3 to 1.8x, with lease adjusted leverage also improving from 1x to 0.5x when compared to underlying EBITDA. And they've said on 16 December 2025, the company announced its partnership with SpaceX to introduce Starlink direct-to-cell satellite connectivity across its 14 markets, serving those customers with compatible handsets. The service will enable data for certain apps and text messaging in areas without terrestrial coverage, with future upgrades delivering high-speed connectivity via next-generation satellites. Airtel Africa becomes the first mobile operator in Africa to partner with SpaceX for direct-to-cell connectivity, reinforcing its commitment to bridging the digital divide and expanding connectivity across the continent. The rollout will proceed in line with country-specific regulatory approvals. Furthermore, in May 25, the company announced a collaboration with SpaceX to bring next-generation satellite connectivity offerings and augment connectivity for enterprises, businesses, and socio-economic communities like schools and health centres in some of the most rural parts of Africa. In terms of valuation, the business trades at a P of 25 and has a yield of 1.5%. I think these are an outstanding set of results. I think the Airtel Money spin out, that's now been pushed back, I think possibly to the second half, which will be from next month of 2026. But yeah, I think these results operationally are outstanding, both sides of the business, Airtel Money and the traditional business. I think the Starlink's quite exciting as well. But yeah, I just think it's a great business. I am unfortunately no longer a shareholder because I have transferred a proportion of my portfolio to Joe Kay, who has been on the show for an interview, to see if he can beat me, which I think he was based on his track record. And unfortunately, Airtel Africa had gone up so much, it was about a 4x, that it was just kind of a no-brainer to trim it down. And then I ended up trimming it down 100% in the end. But yeah, fantastic company. Didn't want to sell it, but it just felt like the right time for me. But if it wasn't for that sort of larger strategic decision in the portfolio as a whole, I would have hung on to it. So, John, as someone who has hung on to it, how do you feel about the results?
I mean, fantastic set of results. The share price has been pretty volatile since, but it's still, hovering, I think, around £3.50. So it's much, much higher than the price that we originally took the stake in. And I think it hasn't been all plain sailing since. And we saw the risk of operating in the countries that it operates in. And with the devaluation of the Naira, that hit us very badly. But now, operationally, absolutely fantastic. Airtel Money has continued to grow really strongly, and we will see what the market thinks it's worth after the IPO. So I'm certainly holding on and a happy shareholder.
Should we move on to another business that I've recently sold for similar reasons that hasn't performed quite as well as Airtel did?
No, exactly. This would probably be one of the things that was detracting from your overall portfolio performance previously. So Novo-Nordisk, they had their Q1 results out. We've covered it a few times on the show. And for anyone who doesn't know, it's a pharmaceutical company which mainly specializes in diabetes. And that used to be the traditional sort of diabetes drugs, and then it was, I think I'm right in saying, the first to market with a GLP-1. So they're the sort of weight loss injection, or most commonly now used as weight loss injections, was part of their diabetic research, and it's good for diabetes. But one of the side effects they noticed when they were doing the drug trials was they got a lot of weight loss as a side effect, and it's now marketed specifically for weight loss as well as separately for diabetes. And in terms of the weight loss drug that they've got, it's branded as Wegovy. When it's used for diabetes, it's Ozempic. They've also got a weight loss tablet, which is also called Wegovy. But, and this is a bit of a history and a summary of it, has been poorly managed, and they've sacked chief executives more than once, and they managed to go from a position of being the market leader to being a distant number two. And from what was a very high valuation, share price has collapsed on the back of this. And the main rival is Eli Lilly with their blockbuster Mounjaro, which does seem to beat, whilst they're not quite head-to-head trials, does seem to beat Wegovy in efficacy. Anyway, that's a bit of the background. So to go to the Q1 results, Novo's underlying sales fell by 4% in the first quarter to 70.1 billion Danish kroner, with increased GLP-1 sale volumes only partially offsetting the lower prices. Underlying operating profit fell by 6% to 32.9 billion Danish kroner, and free cash flow increased by 12% to 12.8 billion kroner. And that was reflecting a decrease in capital expenditure. Net debt stood at 115.9 billion kroner, and dividend payments were stable at 35.3 billion kroner, with buybacks rising from 1.4 to 2.4 billion kroner. Full year guidance has improved slightly, with both underlying sales and operating profit now expected to fall between 4 and 12%, which is still quite wide. And the shares were up 7.3% in early trading. In terms of valuation, the group have a market cap of £114 billion and they trade at 13.4 times forward earnings compared with a 10-year average of 23.1 and a prospective dividend yield of 3.9%. I actually thought these results were okay. I think we have had, guidance which has been disappointing over the last 2 years. I think from my perspective and having some knowledge of what is going on in the market in terms of the GLP-1s, it comes as something that's to be expected. And I think it's very much valued with that in mind. And I actually think 13.4 times forward earnings for a high quality diabetes business like this with a very good GLP-1 on the market. Yes, it's not the market leader, although with the oral ones, it still is. And with what sounds like a fairly decent pipeline, considering how new the market is for GLP-1s and that it's still very much in its infancy and underpenetrated in that sense, I think Novo has got a lot ahead of it, even with that competition from Eli Lilly. And yes, it's Eli Lilly's drugs so far when it comes to the GLP-1s have been objectively better. Novo are able to compete quite well on price. And for example, with Wegovy, when it comes to weight loss, if you triple the dose, which is now being approved from a weight loss perspective, the efficacy does increase to closer to a comparable level in comparison with Mounjaro. So I think with those sorts of things, and that a lot of people, if you look globally, are going to be price sensitive, and also with the momentum that they've got with the Wegovy pill, I think 13.4 times earnings is actually quite cheap. It's also got a decent, half decent dividend yield at 3.9%. Hopefully, the change in management will guide the business forward and they won't have the series of own goals that were the case over the past few years, really since the GLP-1s came online, so 2021, 2022. And I think it's getting away from expecting quite that sort of stunning growth that they had in the very early days. And I think if you say that it's going to be more in the higher single digits, which I think they will be able to do, I like it. And I have it in my own portfolio and I'd be comfortable still holding it, although it has been a bit of a roller coaster in the last, 18 months since I took my first position. Sam, what are your thoughts as someone who has recently sold, albeit for more wider strategic reasons with your portfolio?
Yeah, I think it's a really, really interesting one because I think those results are rubbish, but they are, considering the position they were in a year or two ago, I think the results are rubbish, but they are in line with the guidance they've been putting out. And as well, it had just been battered so much that, like you say, on a valuation basis, it is now quite attractive when you look at the price of it. Even if you're not comparing it to even like Eli Lilly, which is just absolutely smashing it. But if you were to compare it to like AstraZeneca or Glaxo, it's actually quite reasonable. Yeah, I think the thing is, it is a turnaround is the issue. Like how they've managed to end up in the position they're in with, what really, when it first came out, was like a miracle drug. It's absolutely crazy.
Yeah.
They are on a new CEO, which I think is positive because it can't perform any more poorly than the last one, you'd think. But yeah, I think there's reasons to hold on to it, but the thesis has kind of changed. Because it's like, when it had first started to wobble, it's like there is clearly a bit of a trend. It has lost that market leading position. It's not going to get that back. The prices are probably going to be coming down on the GLP-1s. But like you say, it is a massive, massive market still growing. You've still got that insulin business. So yeah, if it wasn't for that wider strategic shift, I would have held on to it. And I think these results, they're in line with what was guided. And I think that the new CEO needs another sort of 6, 12, 18 months. I think if in 18 months we're still sat here and it's not putting up the numbers, at that point, it's like, well, what's it actually going to take to turn this business around? And how long do you wait for someone to unlock that potential? Because as we've seen with Unilever, you could be waiting a very, very long time.
Yeah.
But yeah, I think for now, I would give the new CEO a bit of time, especially given how much it's already fallen anyway.
Yeah. Yeah, it's easy to say, but it does feel like it's sort of possibly overdone. And I think it's interesting to look at this business if you went back pre GLP-1s before they existed. And actually, it was perhaps it wouldn't have commanded anything like, 23 times earnings, but it was chugging along, doing quite well. And then it's almost like this GLP-1 craze has happened and it's sort of distorted how people maybe look at the company overall. But we will see, and time will tell. So revisiting it in 6 months, a year, and I'll probably give it that long. But I'm cautiously optimistic. So we will see.
Should we move on to a business that I've kept?
Yes. So, what makes you keep Rightmove? Is it on the back of these results?
I mean, partly it was because it was in my SIP, if I'm being totally honest, which hasn't moved, but no desire to sell it. So, if anything, I would actually be quite keen to add to it. So, Rightmove, they come out with a trading statement, and it's prior to the annual general meeting. And they've said that guidance remains unchanged since the 2025 full year results, and they're reaffirming their expectation of 8 to 10% revenue growth in 2026. Within the core business, which is estate agency and new homes, they continue to deliver product-led average revenue per advertiser growth, supporting the guidance. They're expecting about 1% membership growth across estate agency and new homes in 2026. And they expect growth in agency to offset new home developments, which continue to see subdued build rates. Strategic growth areas of commercial property, mortgages, and rental services are on track to deliver 20 to 30% revenue growth for the year. And they continue to expect underlying operating profit growth of 3 to 5% and underlying earnings per share growth of at least 5%. Year-on-year growth in the second half is expected to be stronger than the first, with the first half impacted by fewer new home developments and the strong mortgage comparator last year. And Rightmove remains the place to which consumers turn first and return most, representing over 80% of all consumer time spent on UK property portals per Comscore and over 70% per SimilarWeb and Sensor Tower. Over 85% of traffic continues to be organic and direct, and less than 0.5% is referral traffic from large language models, which is flat since the end of 2025. Today, they're launching a new national brand campaign, Glow, across TV and digital channels, which will reach 90% of target UK adults. They continue to accelerate the technology innovation and AI integration. So that's that £1 billion that seems to have disappeared into research and development that we've talked about previously, delivering new tools and features to make the home moving journey more digital, informed, and connected for consumers, and adding further value and features for our partners. In the first 4 months of the year, we recorded over 2,500 technology releases, over 20% higher than the same period in 25, with April 26 recording the most monthly releases ever in Rightmove's history. As part of this, we continue our multi-year journey to increase AI usage across the entire business and now have 43 AI initiatives in flight. Some examples of innovation include they launched a ChatGPT app in March and keep expanding the app's features with tracker property and AI keywords. And in mortgages, they successfully launched a new NatWest-powered mortgage in principle and recently launched an equity tracker, further expanding the suite of valuation and affordability tools for consumers. Latest property market data shows mortgage rates are currently higher compared to December, with average 2 and 5 year fixed rates currently at 5.1% compared to 4.3 and 4.4 respectively in December. In the resale market, house prices remain positive. Available listing volumes are at an 11-year high and at the end of April were 1% ahead of the same point last year. Rental market continues to see an imbalance between supply and demand, with rental prices ahead of last year but with reducing rent growth and demand. There were on average 9 inquiries per available property in the period, lower than the equivalent period in 2025 but still above the pre-COVID annual average of 6 to 7. And new home developments in the market remain at low historic levels due to continued softer build rates, which they expect to persist in the near term. In terms of valuation, the business trades at a P of 14 and has a yield of 2.5%. I think this, I mean, there's not a huge amount in the statement, but I think they've released it because they're probably anticipating quite a lot of questions in the AGM, I'd have thought, about AI. I think they're expecting a lot of questions about AI. They've obviously, the share price has taken a battering because of that, as we've discussed previously. That's why the PE is at 14. But yeah, I think I don't know if it'll be a beneficiary of AI in the same way that sort of Trustpilot might be. I could see AI getting data from it, but at the same time, if they're saying only 0.5% of their sort of inquiries are coming from AI, I think it's probably going to be fairly neutral. I'm skeptical, as we've discussed, about how that £1 billion that's been invested in AI is going to return money to shareholders. But I think at the end of the day, the core business is not, I don't think, going to be damaged by AI. I think it's just got such a strong monopoly. I think the best case scenario is that AI is pinching stuff from there and then sourcing it. So you're probably going to end up getting fed through to Rightmove in the end anyway. I don't think it's in the same position as maybe a Relux or a Money Supermarket. So yeah, I don't know if it'll be a beneficiary, but I think it's pretty neutral. And I think at a PE of 14, I think it's just a fantastic valuation for what is a really high quality business. What do you think, John, as a fellow shareholder?
Yeah, no, I'm quite happy. I think it's something that I've reflected on a lot over the past few months, and what sort of moat does it have against AI? Because in terms of the market moves, it's almost been in that same basket as whether it's Auto Trader or Relix. Those kind of companies experience another one that are data rich, and they've all suffered a lot. And I suppose that's whether they do have the moat against AI, or whether AI, for example, you're not going to need a Relic subscription because it can just do it for you. I don't think that's the case with Rightmove. I think the data is sort of protected and it has kind of a moat around it. It has the apps, everybody goes to it, whether it's the consumers or whether it's the agents, as the source. So whether it would benefit specifically from AI, I think, as you say, more likely to be neutral. But it's got those massive margins and the growth is still pretty decent. And it's 15 times earnings. Or did you say 14 times earnings?
Yeah, 14.
14 times earnings, which is the cheapest it's been in, well, I can't remember the last time it was that. It may be since listing. So if it can keep putting up those numbers at 14 times earnings, it's, well, I consider it sort of dirt cheap. I'm holding my shares and I'm probably going to be topping up on it too.
Yeah, I think it's a very, very attractive valuation. I mean, it's basically a monopoly to get that for 14 times earnings.
Yeah.
And we've seen, like CoStar, when they bought on the market, they've tried to knock them off their perch.
Yeah.
Here we are sort of 2 years later.
Yeah.
It's done nothing, literally nothing.
What was the price that the Australian Rupert Murdoch's company bid for? Was it £8 a share? Something like that?
I think it was over 7.
Yeah.
I do have a figure in my head of over 7. So in terms of the share price now, it's at £4.20.
Yeah.
So I'll get the graph onto 5 years. Yeah, so I mean, it's shot up to £8.12 a share, which must have been, that's the highest it's been.
Yeah.
So yeah, I mean, it's not quite down 50%, but it's not a million miles away now.
The numbers that they're putting up haven't changed.
No, they haven't. So far, it has been unaffected.
Yeah. We'll see. Anyway, time will tell again.
Should we move on to another cheap business?
Yeah, well, a very cheap business, arguably less of a moat. JD Sports, so we've covered them plenty of times on the show before. Sports / fashion, urban wear retailer. They had their full year results out with full year revenue of £12.7 billion against £12.8 billion expected, which was up 11.7%, ignoring exchange rates, with growth largely driven by acquisitions. On an organic basis, sales grew by 2.1%, with growth in all regions except the UK. Underlying pre-tax profits fell by 6.4% to £852 million against the £848 million expected, driven by higher operating costs due to acquisitions and store expansions. Free cash flow rose by 36.3% to £462 million, and net debt, including lease liabilities, fell by around £200 million to £2.8 billion. Organic sales growth was flat over the first quarter. Full year guidance points to underlying pre-tax profits of between £750 and £850 million, and that was against £832 million expected, with free cash flows of between £460 and £520 million. The group also announced a 20% increase in the full year dividend to 1.2 pence a share, and a £200 million share buyback programme is underway and expected to be completed by the end of the year. The shares were up 3.3% in early trading, And in terms of valuation, the group have a market cap of £4 billion and they trade at just 5.7 times forward earnings compared with the 10-year average of 14.9. I mean, these results for the price that the group is trading at seem very, very cheap. It's got headwinds against it and it's a difficult macro situation in the UK at the moment. There is the ongoing threat from direct to consumer with big companies like Nike and Adidas going direct to consumer. And obviously that does threaten the whole model of JD. But we seem a long way from that really, hitting the bottom line here. So I'm surprised, whilst the results are not the best, they're also not what you'd expect a company trading at 5.7 times forward earnings at. It's not something I can really get my head around in terms of why it's so cheap. It's not a business that I'd be inherently attracted to in terms of it's a retailer and there are the longer term headwinds of direct to consumer, but I can't quite see why it is this cheap. And you do wonder if it is this cheap, and particularly when it seems to be doing reasonably well in the US, whether it's going to be the target of a takeover at that kind of valuation at present, and whether it's one of those undervalued sort of FTSE 250 companies that would be attractive to overseas investors. Sam, what are your thoughts?
I think it is cheap. I wouldn't necessarily say cheap for a reason, although I think longer term, I do agree with you. I think the market isn't necessarily one I'd want to be in. I think I wouldn't want it because it's retail anyway. I think it's dependent on those relationships, despite being kind of one of the biggest players in town and a very important customer. But longer term, the Nikes and Adidases of this world, they will want to do direct to consumer. That has lulled a bit in the last few years, but you'd think long term, you're going to log on. I just think, in 10 years' time, people will just be logging on, designing the pair of trainers they want, and Nike or Adidas will just send it to them. If you could do it that way and design a nice pair of trainers that you were really happy with, I don't think you'd necessarily walk around JD anymore. But so far, that hasn't happened. But yeah, I think it's always been a decent business, but then it's like, I wouldn't be interested in it because it's retail, but also I think it's cheap is just not a good enough reason to buy it.
Yeah.
Just because, say it should be, what should it be at? I'd probably expect it to be more like a PE of 10 if it's not putting up really good growth. I suppose if you bought it at 5.8 and it got to 10, you'd do pretty well. But if something happens and those margins get cut, those earnings come down quite quickly, and then all of a sudden it might actually be at 10 all of a sudden, but the earnings have come down. So I just think as well, if I wanted an apparel retailer that was down 2/3, I would just be buying Nike, which I already have done, and I'm down 20% on it. But I don't want another retailer, but I think, Nike's a higher quality business. They're in a similar industry, so it just wouldn't interest me for that reason. But yeah, I think on the surface, it does look probably cheaper than you would expect, given the numbers it's been putting up. And this is, not just in the last year, but the numbers it's been putting up since we started the show probably don't justify this valuation.
Yeah, fine. What about Trainline? How are they doing?
They're doing okay. So Trainline, they have come out with their full year results. Net ticket sales are up 7%. Their revenue was up 2%. Adjusted EBITDA was up 11%. Operating profit was up 43%. Adjusted basic earnings per share was up 23%. And the basic earnings per share before adjustments was up 48%. And the adjusted free cash flow was down 9%. The adjusted EBITDA, which was up 11%, they've said, with operating leverage and cost discipline more than offsetting the impact from previously flagged commission rate reductions. They're Europe's most downloaded rail app with a total active customer base of 27 million. They're leveraging tech and data strengths to deploy AI strategy across the business, strengthening the position as the UK's number one travel app, including deepening engagement with 18 million customer base. Digital railcard customers are up 16% to 2.7 million, and the share of 16 to 30 railcard users is at 45%. Strong double-digit growth in hotel bookings and insurance sales. Progress in challenging operator self-preferencing. Government committed to allow third-party retailers to offer delay repay once Great British Railways launches. positioning themselves as an aggregator of choice in Europe. Sales in Southeast France up 26%. Improved international consumer profitability, expected to break even in the 2027 year. In terms of the guidance, they expect net ticket sales of 6.2 to 6.45. That's pretty much where they were this year. It was kind of in the middle of that range. So that's very low to nil growth there. Although I guess a lot of the ticket prices have been kept flat. For example, I think Labour have announced a price freeze, so that might be why. Revenue of 440 to 455. That would actually put the current revenue at the upper end of the guidance for next year. So basically no growth, maybe a slight decline. Adjusted EBITDA as a percentage of net ticket sales at 2.9%, with international consumer expected to break even. They've repurchased, as of 30 April, 94 million shares under the 150 million buyback program. And for context, that is on a market cap of 793 million. So it's actually quite a decent chunk. And 294 million of shares have been repurchased since first launching the buyback program in September 23, and that represents 23% of issued share capital. In terms of valuation, business trades at a PE of 9. There's no dividend, but there is the buybacks, which, as we said, are quite decent. I think we've talked about it before, but it's a business I'd never be interested in. I think the issue is, firstly, I think it's probably quite saturated at this point in the UK. You've got the international, but I think the concern is that it's the kind of thing that you would think a government might want to step in and do themselves. A lot of the rail providers, if you're getting regularly enough, if you go direct to, it's like I've got the Northern app on my phone. If I'm going to London or something, which is more occasional, I will do it through Trainline because I don't mind paying the extra 50p or £1 or whatever it is on a ticket to London, which is more expensive, to save the hassle of downloading a new app on my phone just for a journey I might make once a year. But for example, I do commute into work by train. It's the same line I'm getting every day. I've just got the Northern app, so I've cut Trainline out completely. If they try and take too much commissions, they're probably going to get they'd be a target for government intervention. It's a kind of platform that you think a government would want to provide themselves potentially. So yeah, I just think in terms of that political risk, I wouldn't touch it. But as a consumer, I think it's a pretty good business. But yeah, uninvestable. What about you, John?
Yeah, I would also agree it's uninvestable. I think the point you make about nationalisation is completely valid. And I think that's been the main reason why I wouldn't have looked further at Trainline. The other thing that I've come across as a consumer in the last couple of months is I've been doing some more train travel recently. And the app that I've been using is Uber. So Uber are expanding quite aggressively into trains too. And the way that they're doing this is you have the Uber app, which obviously you can order your Uber on it, but you can also easily, just like Trainline, buy a train ticket, add it to your digital wallet. And the thing that Uber are doing is no fees. I know this may be down the line, they'll probably start them, but no fees. And they're offering you 10% discount on the fee as well. So it's considerably cheaper than Trainline is now. And it's a very easy app to use. And if you did use Uber, you might be more likely to use that too. The other thing you can do with the Uber app now is you can buy bus tickets on it. So if you're commuting, you can buy your bus ticket, you can buy your train ticket, and you can potentially get an Uber. They're also doing promos within that, in that you can get Uber credits and then you can use them for Uber Eats, you can use them for Uber travel in the sense of taxi or conventional Uber, but then also on the buses and the trains too. So I think there's a lot of competition, and you look at Trainline, it's a relatively small company. In terms of tailwinds, I think probably moving into Europe, and if you were certainly traveling through Europe and you didn't want to have lots of different national providers and different apps, it's quite easy to use. You can use it in your own language, which is nice. But I think there's competition, both if government decides to nationalise and also then on the other end of it from other private providers that are a lot bigger and probably happy to use this as a bit of a loss leader too and aggressively compete with Trainline whilst they're growing their market share.
But then as well, like, for example, I'm probably going to now have a look at Uber for like longer journeys where I'm not using Northern Rail.
Yeah.
And then on top of that, in Europe, one thing I do when I'm in Europe is, although Trainline's really good for finding the trains, If you then just go to the station, you can just buy them, and
Yeah.
because you do end up losing a couple of euros if you actually buy it through Trainline. So I
Yeah.
tend to use it to find the trains, and then I know what train I'm looking for on like the terminal at the station, and I
Well,
just buy it through there to save the couple of euros.
well, now next time you can just use Uber, and there'll be no fee, and you'll get 10% back.
Yeah, so which I think tells you part of the problem they've got.
Yeah, yeah,
So
yeah.
should we move on to a business that's also had some problems recently?
Yes, no, that's right. So it's one that I still own. Disney probably doesn't need very much introduction. I think everybody knows what it is. It's broadly just to explain the structure of the company. It's broadly got three parts to it. So it's got its traditional park business, Disneyland. Well, you've got them everywhere. You've got them in Florida. You've got them in LA. You've got them in China now. You've got Paris, and that's the traditional parks business. You've got the streaming business. So that's Disney Plus largely, and then you've got the sort of, I suppose, traditional, more sort of cable business, which has been dwindling in recent years. Anyway, Disney had their second quarter results out with revenue up 7% to $25.2 billion against $24.8 billion expected. All divisions were in growth territory, with entertainment growing at the fastest pace of 10%, largely reflecting the higher subscription revenues. Segment operating profit grew 4% to $4.6 billion against $4.2 billion expected, and this was driven by top-line growth, partly offset by a decline in sports profitability due to unfavourable timing of contract renewals. Free cash flow rose by 1% to $4.9 billion, and net debt was $41.7 billion at the period end. Third quarter segment operating income is expected to be around $5.3 billion against $4.6 billion expected, and full year guidance now points to underlying earnings per share growth of 12%, previously double-digit growth. The group expects to complete at least $8 billion of share buybacks this year, and shares were up around 3% in early trading. In terms of valuation, Disney has a market cap of $176 billion and trades at 14.3 times forward earnings, compared with a 10-year average of 23.3, and it has a prospective dividend yield of 1.6%. I thought these results were actually pretty encouraging, particularly with what we've got used to over the last year, 2 years. They certainly weren't shoot the lights out, but at the current valuation, under 15 times earnings, I thought there were some encouraging signs here. I think also what we hadn't seen with Disney is them significantly increasing the price of the subscriptions. I think seeing that they're able to do that and hopefully not lose significant subscriber numbers would be encouraging. I think that one of the difficulties is that they've got such strong competition from Netflix, and that Netflix as a subscription, now that it's been around for as long as it has been, we've seen quite how sticky it is, and that even when they have increased the prices, they haven't seen huge churn in terms of the customers or subscriber numbers, which again is encouraging for Netflix. And I think that probably does go some way to show the quality of Netflix and the diversity of the content that they've got on there, and that they have got real quality and some series that keep coming back. So they sort of built their own brands in that sense. That being said, I think Disney's brands are incredibly strong. I think probably more of a headwind from it is coming up with new IP, which I think it's fair to say they've been weaker on. They've got a lot of strong historical IP, but a lot of the Marvel universe has become a bit lackluster now, and it feels like they've squeezed as much as they possibly can, and they probably do need to go back and be more creative again. Park business feels again like it's sort of been chugging away, but not delivering anything too spectacular. So I think if they could really get back to creating some more, exciting IP, and then obviously that puts it through the experiences segment, the parks business, and also through the streaming, I think that's where the growth of the group would come from. But actually, at its current valuation, I don't think the market's expecting a huge amount. So I'm quite happy holding. And that's the first time I can say that for a while. Sam, what are your thoughts as someone who no longer holds Disney?
Yeah, so I mean, for context, this was actually sold after the last set of results. Or maybe even before that, but this was sold for a house deposit rather than more recent strategic shift. But that again, when I needed the money, that felt like an easy one to get rid of, because I think I must have held it 4 or 5 years at that point. Never really delivered the numbers. I thought Disney Plus, they never really put the numbers up from that I thought it could have done. I don't think they've used the IP in the right way. You look at what Netflix has been doing over the same time. Bob Iger's come in. He's come back in for a couple of years and it's not made a real difference. And I thought for me, that was something I really thought would be a catalyst to get it back growing again. And these results are okay, but it's a bit like, this is, I mentioned it earlier in the show. It's a bit like Unilever. How long do you give it for someone to unlock that value? Because I think for me, if Bob Iger couldn't unlock it, he was. If I could have picked anyone to come back or to come in after Bob Chapek, I would have said, "Oh, well, I want Bob Iger back." So I just think, that there is value there, but how long do you leave it, and how much does it then have to catch up if you've not been getting a market return whilst you wait for someone to come in that's actually competent at the job? Also, as well, I don't like how 5 years ago we were talking about the debt. It's not moved. It's always 40 billion net debt. I don't understand why they can't pay it off. The rates won't be as good as they were 5 years ago either. So I don't really like that either. But I just think in terms of what I think they're very, very lucky. And the most positive thing I can say about it is that the Netflix Warner Brothers deal didn't go ahead.
Yeah.
So I think it's less of a problem with Paramount owning it than it would have been with Netflix with that IP, because that would have just been a scary combination.
Yeah.
As a Disney shareholder. But the value's there. Someone will unlock it. It's got some of the best IP in the world. It's a great business, but how long do you wait for it to deliver? That's, I think, the issue I've got with it.
Yeah, no, fair enough. Okay, then, of the companies this week, what would be your first choice and what would be last?
So I think in terms of pure numbers, I thought Airtel was probably the best. Would I buy back in at a 25 times PE? Probably not, but fantastic business. Really, really think. I think covering it as a non-shareholder for the first time in about 5 years is it's still absolutely fantastic. And I think at 25, you can still make a very good argument for it. If it wasn't for the reason for my sale, which I talked about, I would carry on holding that at least until Airtel money spun out, and then probably even then give it 6 months before making a decision, because I think it is a great business. So I think probably I'd go with Rightmove based on valuation. Least favourite, I think it would just be Trainline. That's quite easy just because it is totally uninvestable. What about you?
Yeah, I think first choice, I would probably go with Rightmove on valuation. I think it's a quality company, but it looks attractive at the moment. In terms of last, I think I'd say Trainline. I think that's just an industry that's uninvestable. So that's quite easy.
Right, I think that's everything in that case.
Thank you very much for listening, and we will see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.